Investors continue to flip-flop between AI euphoria and Middle East headlines, but for now, they remain firmly focused on earnings and technology optimism and try to minimize the Middle East news as much as possible. So the S&P 500 and Nasdaq 100 both pushed to fresh record highs yesterday, with semiconductor stocks leading gains across both the US and European markets. At the same time, geopolitical worries appear to have a diminishing impact on sentiment, with investors out there increasingly brushing aside war headlines unless tensions materially escalate. And the economic data is softish but not alarming. So welcome to Swissquote's Daily Market Talk. It's Wednesday, 6th of May. I'm İpek Özkardeşkaya. We will try to make sense of the news, headlines, economic data, and corporate earnings. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the Project Freedom was paused yesterday, meaning that the US will not try to escort ships out of the Strait of Hormuz for a while, as the latter did not fare well with Iran. And while the good news is that no further escalation of tensions in the Middle East was just enough to divert investors' attention toward earnings again, and the rally that paused for a few hours at the start of this week resumed. The S&P 500 and Nasdaq 100 both pushed to fresh record highs yesterday, as the European Stoxx 600 index rebounded from its 50-day moving average. Gains were led by the technology names on both sides of the Atlantic Ocean. Van Eck Semiconductor ETF, for example, traded at a fresh record high yesterday in the US, while ASML rebounded 3.5% in Europe yesterday, and Infineon Technologies, which is a German chip maker, not an AI chip maker, but a chip maker still, and one of the largest European chip makers, rose more than 8% to a record high before announcing its earnings. This morning, I haven't seen the earnings just yet, but today, the Kospi Index also confirms that optimism with more than a 6.5% jump at the time I'm talking here. So overall, the market mood now flip-flops between the AI optimism and the Middle East news, with Middle East worries, however, impacting less as we move on and shorter period of time as investors become used to the war headlines. This is what happens in geopolitical tension periods. I believe that there is still a certain ignorance and underpricing of the risk here due to the impact on global oil flows, but the reality is that the perfect calm for entering a position in the market doesn't exist, or it doesn't exist anymore. We're either confronted with geopolitical crisis or trade war or high valuation. So today it's a mixture of all, yet the major indices are doing well, including EM indices, because MSCI's EM index, for example, also hit a record high yesterday. The stock rally per se looks like serving as a hedge against inflation, though the risk of a sharp reversal cannot be ruled out given the uncertainties. But oh well, investors just don't want to hear about it. And while uncertainties and worries didn't really show up in the earnings so far, more than 80% of the S&P 500 companies that reported their earnings so far, reported better than expected revenue. In Europe, around 45% of the Stoxx 600 companies surpassed the revenue expectations. It's good, it's not as good as the US, and the gap is certainly due to the technology exposure of these continents and the indices. Because again, yesterday, AMD delivered a strong earnings beat, with first quarter revenue rising 38% year over year to more than $10 billion and the data center sales surging 57% thanks to booming AI infrastructure demand. It was better than expected. The company also guided the second quarter revenue above expectations, reinforcing optimism around its AI accelerator and server CPU businesses. The market's reaction was as positive. AMD shares jumped 16% in the after-hours trading as investors cheered the strong AI-driven growth outlook and improving visibility on future demand. Supermicro Computer, on the other hand, also jumped around 18% in the after-hours trading after delivering mixed results. Earnings here beat expectations comfortably, helped by improving margins and strong AI server demand, but revenue missed estimates as some customer deployments were delayed. But the company nevertheless issued upbeat guidance for the current quarter, signaling confidence that AI infrastructure spending remains robust. And we do know that it does remain robust. So investors focus on the stronger profitability and guidance rather than the revenue miss as a confirmation of the strength of this fresh AI-led optimism that we are going through today. So this morning, with no further escalation in the Middle East and falling oil prices, the US and European futures are pointing at a positive start. That relief is also notable in the US dollar index that is trading lower this morning. The US dollar is indeed lower against most majors. The euro dollar, for example, is pushing above the 117 mark at the time I'm talking, while the dollar yen is all the way down to the 155 level, the lowest in 10 weeks, also helped by direct FX intervention from the Ministry of Finance. Indeed, Japan is closed today, and thin market volumes during a holiday make this kind of FX intervention more efficient because it moves the market faster. But again, the latter helps clearing the speculative short positions against the yen for a while in the short run, but not necessarily reverse the yen's medium-term outlook. We need a BOJ hike for that, or a more dovish shift in other central bank expectations, which would in return require a stable and a sustainable easing in the Middle East tensions, and ideally in the price of oil as well, which is a scenario today that looks highly uncertain, unfortunately. On the economic data front, the US data was mixed yesterday. The ISM printed softer activity in March for the non-manufacturing sector, while job openings in the US fell less than expected in the month of March, and new home sales rose during the same month compared to a month earlier. Today, all eyes will be on the US ADP report, where expectations are that the US economy may have added around 118,000 new private jobs in the month of April. Now, what's interesting is that the predictions diverge. On one hand, the thousands of job terminations announced by big and smaller technology companies thanks to AI replacement weigh on jobs estimates. On the other hand, these same companies spend hundreds of billions of US dollars for building massive AI infrastructure that creates jobs. But the latter is not hitting the headlines as hard as the big technology job losses do. So the question is whether the job losses are stronger or softer than the job gains due to AI. I guess we will see in a few hours and in the coming days. But the way the market will process the news will certainly be impacted by the positive vibes of the moment, meaning that a softer than expected jobs data could revive the Federal Reserve doves, pull the yields lower, and back a further equity rally. While stronger than expected figures, on the other hand, could confirm that the US economy is not doing that badly after all, and cement optimism and push equities to fresh all-time high levels as well. And given the resilience to bad news and the enthusiasm around good news these days, I certainly do not see the bears taking the upper hand in the coming days. But sell-offs happen suddenly, and the Middle East risks still loom. Now, one interesting thing though before we go, some analysts note that the positive reaction to the earnings beats this earnings season is smaller compared to the negative reaction to earnings misses. The latter is a confirmation that the valuations are quite high in the US and the US stocks are expensive. The question is whether this optimism could spread into other markets. And the answer is, it depends. The Middle East tensions clearly shifted capital flows toward technology names, and that is true for inside and outside the US. Because European and UK stock markets lagged behind the technology-heavy indices like KOSPI and TAIEX, for example. The rising energy costs first hit the Asian indices harder, but the negative impact on the market mood lasts longer in Europe. And given investors' appetite in hiding from the war under the technology's roof, the underperformance of the European indices will likely remain in play until more clarity in the Middle East, and ideally a notable retreat in energy prices as well. Otherwise, the European economies will also face higher interest rates from the European Central Bank into a slowing economic outlook. And that, for the cyclical European indices, is not necessarily good news. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.